Money FM 89.3, best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. We've got some buying on the dips, helping the S&P 500 and the Nasdaq push up to new all-time highs. And that's a day after the broad market index snapped a 7-day winning streak because of a drop in Oracle, which called to question the sustainability of the AI trade. The U.S. government shutdown is also into its second week, but investors shaking all that off and helping to push up the S&P 500 higher by 0.6%. And this led by the IT sector, utilities, as well as industrials. The Nasdaq composite advanced 1.1%. On the flip side, the Dow rather flat, just slightly underwater by 1.2 points. Let's check in now with Fabien Yip. She is the market analyst for IG. Fabien, good morning. How are you doing?
Morning, Ryan. I'm great. How are you?
Great to have you on. Let's talk about the latest session. It looks like despite all the noise, markets pushed higher. Not a lot of reaction to the latest FOMC minutes, which reflected the latest rate cut for the first time this year. And we saw in the minutes a pretty divided Fed. Walk us through how much of that mattered to investors.
Actually, I think a lot of what we read from the FOMC minutes have already been expected by investors. We knew from the dot plot that came out from the September meeting that views amongst members have been pretty divided. We know there is someone who is extremely dovish, who has just been added to the board last month. But we also know that some of the members are a little bit more cautious on inflation risks that could be brought by potential higher tariffs, the negotiations still going forward with Trump and President Xi. So I think a lot of that news that we are reading overnight has already been factored in by the market. And what we're seeing right now in the rates market is that there is just a tiny bit of adjustment in expectations for a cut in October. So that probability came down slightly from 95% to 94%, but still, looking at that number, it's still very high expectations that the Fed will be cutting in October.
Yeah, Fabien, talking about rate cuts, how much of that has to do with the play, at least in the gold prices that we're seeing right now, pushing up to new highs? So it's not just equities pushing to new highs. We've got gold breaking above the $4,000 mark. What is driving gold prices? How much momentum is behind it?
Right, I think rate cut expectation is definitely an important factor because assets like gold, which do not yield, typically benefit when rates come down. But we're also seeing a lot of net flows from ETFs, so a lot of interest from investors. In fact, September has been a record high net flow month with $17.3 billion USD going into physically backed gold ETFs, and it's also the fourth consecutive month of net inflow. On the other hand, we are seeing a lot of interest from central banks around the world as they continue to increase their allocation to gold in their reserves. So, for instance, Poland has been the largest net buyer and has recently raised their gold share within their reserves from 20% to 30%, and China has also been adding for 11 consecutive months. So a lot of really supportive factors for gold prices, and that's why we've seen such a rally.
Yeah, talking about China, we've got a bit of an outlook coming through with the latest from the World Bank, and they are talking about how China is looking at, I suppose, a brighter outlook of sorts. What do you take away from the latest expectations going forward?
Yeah, we did see an upward revision from the World Bank on China's growth this year to 4.8%, which is kind of closer to what China has itself set a goal of 5%. And the upward revision, we think, reflects the temporary relief on trade restrictions between U.S. and China, as they have been on truce since May. But the situation could quickly change as the agreement expires on the 10th of November. So we'll still have to wait and see. I think the important bit to kind of think about is the mismatch between the real economy and the stock market. So if you look at the CSI 300 index, it's up 18% year to date. Hang Seng is up 34% year to date. And today, the onshore market will reopen after a long holiday for the National Day. I think we are basically looking at a discrepancy because with the numbers that I just talked about in the stock markets, these are really, really impressive returns. But if you look at the real economy, right, think about the real estate sector, which is accounting for close to 25% of China's GDP, direct, indirect. It shows little signs of recovery. So we're seeing housing prices in both primary and secondary market continuing to fall in August, and it's dragging on sentiments and economic growth. Meanwhile, the year-to-date rally in the stock markets have largely been supported by consumption growth stimulus as well as AI boom. But we're still seeing prices coming down in terms of what the manufacturers are outputting, and the corporate margins have been reduced. So if you look at the earnings growth in China in the second quarter, it's just 1.6% year on year. So without a meaningful improvement in corporate earnings, I think the sustainability of the equity rally could be questionable. So we need to be a bit more cautious in that divergence between market sentiments on how positive they think about the AI boom and at the same time the real economy growth.
All right, talking about divergence, the BOJ has been trying to hike rates, quite a different story versus the rest of the world. But the Japanese yen has hit its weakest levels since mid-February against the US dollar, at least, on rising concerns about various things. And we also have a new leader coming through for Japan. Walk us through all the various factors that are going to be driving the Japanese yen going forward. Is this going to be a return of the carry trade?
Yeah, that's right. So over the weekend, we saw Sane Takaichi has won the LDP presidential election, which is likely going to make her the new PM of Japan, and she's been considered as a protege of previous PM Abe. So we all know about Abe economics, which is basically supporting high fiscal spending and cheap borrowing. And this is why the market has reacted that way. We have seen that the yen has weakened significantly, like you said, Ryan. And on the other hand, the yield of Japanese long-dated bonds have also surged. So with the 20-year yields going up from 2.6% prior to the election to 2.7%, what we're seeing right now. We think that the trend where yen has been strengthening since the start of the year, that is probably over. So US dollar versus yen could possibly target February's high at 154.7. And with yen being that cheap, the yen carry trade could possibly return. But let's not forget what happened last year in August as well, when the yen carry trade unwinded. That also caused a lot of turmoil in the Japanese equities market. So we need to be cautious of that.
Okay, lots to watch in the coming days. The Japanese yen, gold prices, and how the market's feeling about equities with all the noise with the US government shutdown, and a lot to keep track of. And we've been in conversation this morning with Fabien Yip. She is the market analyst for IG. Fabien, thank you so much for your time and insights as always.
Thank you, Brian. Have a good day.
We'll catch up with you again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3.